I feel honored to be on this panel today. I think everybody on this panel I've actually solicited business from at some point in my career. No. But as you can see, we have a very august...
I got a question. Did you win business from any of us?
Well, not from you. But Scott was generous enough to let us manage a few shekels. So.
We're still talking.
Thank you. I appreciate it.
We're still friends, right?
I wasn't sure if we were still talking. Anyway, and Hiro, he's got a lot of money, so I figure we should get something from him eventually. But.
Thank you.
Thank you. Yes. So, for those who don't know who's here today, to my left is Chris Ailman. He's the CIO for CalSTRS. And Vicki Fuller, who is the CIO for the state of New York. And Scott Evans, who is the CIO for the city of New York. And Hiroshi Mizuno, or Hiro Mizuno.
Hiro.
Yes. Who is what is your official title, Hiro?
My official title?
Yes.
Executive Managing Director and CIO.
Of Japan Pension.
Of, Japanese government pension fund.
Oh, there you go. Okay.
We call him the big guy in charge.
So, Hiro, since you win the contest for having the most assets under management of anybody on the stage, maybe I should start with you. Let me start with an easy question, which are, what are your return objectives, and how do you meet them in today's ultra-low return environment?
Sure. For the people who are not very familiar with GPIF, first of all, I just want to briefly describe what we manage to give you a better sense. Because we are GPIF, which stands for Government Pension Investment Fund. So the people think that's the government employees' pension fund. But reality is that this is like a social security. So every single Japanese has to be a part of this mandatory funding scheme. And we, at the moment, manage $1.34 trillion, depending on which day we mark to market. And then it's a defined benefit scheme for Japanese pensioners. So for that fund, we are required by the government to make a return of, just make it simpler, it's a real 1.7%. So at the moment, the inflation rate is pretty much zero or negative, so we are just aiming 1.7%. So to achieve that, we came up with a policy asset mix of 50% in equity and 50% fixed income. And for equity, we have quite strong country bias, so 25% in domestic or Japanese equity and 25% in non-Japanese equity. And for fixed income, 35% in Japanese government bond, plus Japanese corporate bond, fixed income, and 15% in non-Japanese or foreign fixed income. That's the policy asset mix. So under the current circumstances, as you can say, half of our portfolio is yielding zero because Japanese government bond is negative and Europeans are negative. We get the slim yield from US, so the fixed income pretty much returning zero. So in that circumstances, how we can manage navigate through the volatility of the equity return is going to be a big, big challenge for us.
And how do you find, given the transparency that you have, the frequency at which you report, how do you find the focus or balance the focus between short-term returns and long-term returns? Because obviously you answer to someone, and if you have a couple of bad quarters, right, I'm sure there are questions. So how do you balance between long-term and short-term views of the market?
Well, that's probably the biggest challenge for GPI, for somebody like you, that the public pension is always under the pressure of transparency and accountability. And believe it or not, we organized a press conference to report quarterly results. So we go on a TV, we go on a media every quarter, and when we make a good positive return, nobody pay attention to. And when we report the quite a shocking number, because given our size as a loss, a quarterly loss, we got a lot of media coverage. So we keep saying we are a long-term investor, and actually our fund is designed to make Japanese public pension system sustainable for the next 10 decades. So we are probably the longest. I think in 100 years' time, we may be the only one standing DB program in the world. But so that's a total mismatch between what our real mandate is and what the requirement of a media or a public about their transparency. So we just keep saying the same boring thing, saying that we have to pay attention to long-term results, but it sounds like a cliche. And also, I think asset owners are kind of top of the food chain of this industry. So as far as we continue to just kind of take people's attention on a quarterly basis, actually probably influence or affect how the corporates or asset manager do their business. So I'm quite sort of have a big reservation about we go that transparent or that they are taking too much attention on a quarterly-based number.
Right. Well, tell me, Chris.
Scott, can I jump in on that?
Yeah, please.
Just picture that. You've got a 10-decade time frame that you're thinking about investing across. And people want to measure 91 days of that performance. I always use the analogy that our investment horizon is like a marathon. And I know I've learned marathon runners pay attention to the pace per mile, but they don't obsess about it. In your case, they're paying attention in that marathon to the first foot, the first meter they ran. It's crazy to look at that short time period when you have that time of a horizon. You want to be transparent. You want to share information with people. But I think the challenge, as you said, the danger of short-termism is really we have to change our language. We have to get people to think longer term so that they look at us as, 1 year is barely the pace of a mile in your 10-decade marathon. Yeah,
that's the discrepancy between mismatch between not only us and our pensioner, but ourselves and asset managers, and ourselves and the corporates as well. So on one hand, we are criticizing about the short-termism. On the other hand, we are reporting numbers every 90 days. So this is something we need to address as an industry.
Yeah. No, we're reinforcing the behavior. Because, and I think it really does start with us. Our board only reports performance every 6 months. But even then, 6 months is a meaningless number when you've got a 30-year horizon. And what we're trying to do is really say, look, we'll do the press conference or the public announcement once a year, but the headline number has got to be the 5-year, the 10-year, and the 20-year return, because that's how you measure a defined benefit plan. In the text, we'll put the 1-year return, but we're not going to talk about 6 months or 91 days because it's meaningless.
Right. Vicki, how do you handle this issue given that, I think your investment return assumption is what, 7.5?
7.
7? And, given an environment like this where returns have been so low, how do you handle, communicating that to you have a sole trustee.
Yes.
Right? So how do you handle that, and how do you handle the political side of this, which, this is obviously, the state money. And, if the returns aren't hitting the targets, that's got to put a lot of pressure on you. So how do you manage this short-termism versus the long-term objective?
So the one thing I would say, I agree with what's been said before about the publishing of a number. So to Chris's point, we also report a quarterly number. And the history behind that was when the current comptroller who I work for came into office, there had been an old bad period where we were accused, where the plan was accused of being very opaque. And this was one of the things he said he would do, and that was open kimono. This is a terrible word, I apologize for that, but he would report the number quarterly. But it wasn't because he really expected investors to opine that if you annualize a 1% number, we were or weren't meeting our return assumption. So we, about a year ago, completed our most recent asset allocation and asset liability study. And we were very communicative with our advisory council and with the comptroller about the challenge of meeting 7%. And even though, we had met it in many ways because of beta over several years. And so we put together a asset allocation, which, as many of you know who have done that, if you have a 7% number. It also says that your geometric return is 6.5, and if you go further, it says that there's a 50% chance you won't meet that return. And we spent a lot of time talking about just that fact, that given the dynamics that we were seeing in terms of economic growth and inflation and interest rates, it was going to be very difficult to make. But we also went further because, like many public funds, we suffer from a dearth of talent. And a process that makes it cumbersome to add people and to pay them better. And we went line by line through each asset class and said, okay, let's take private equity. We have a 10.5% return assumption over the next 10 years. However, to make that 10.5%, we're going to need to add the following people. If we don't do that, and if you went asset class by asset class, it ended up being some 35 to 50 people that we needed over the next many years to really be able to have the skill and the talent to make that asset allocation. So while we report quarterly, we've been in sort of, I guess, ongoing communication with everyone, including our actuary. And so that's the way we're attempting to manage it.
Right, and it's got to be a real challenge to, to hire that many professionals. We were here just yesterday with Mike talking about the number of resources that are necessary to manage some of these more complex asset classes. So, I can see that, to get that out of the legislature or whomever you have to get it from, it can be a challenging task.
Yeah, but we've been very deliberate and transparent and said, we serve 1 million plus people. Our job, our mission is to provide them with a secure pension. We're telling you that in order for us to continue to do that over the next many years, given what we project the environment will be, is going to be the following. So we're going to jointly, if we don't get it, we're jointly saying that we're agreeing that we won't be able to meet it.
Right.
And so we're being very we have actually an ongoing sort of outreach to say we really need to do that.
Right, to get the resources.
Yeah. Right now we have 37 people.
Right.
And that might sound like a lot. We're the 3rd largest pension plan in the country after CalSTRS, but it's not, because we manage all of our fixed income, which is about 26% if you include tips. We manage that internally. We manage 90% of our U.S. book internally, and that's $50 billion. And so when we sort of looked at our peers, we were bottom quartile. And this is taking the top 50 plans in the country, bottom quartile across asset class in terms of the number of people. And if we add the 50, that'll just take us to median.
Right. So it's running an organization today where we have $250 billion in assets, and we have 275 investment professionals on top of the operations staff that it takes. So I mean, it is a very human capital intensive activity, and returns are affected by the quality of the human capital.
And
just a short soundbite. I think it fits within our title. I learned from a guy named Steve Myers, who ran South Dakota several decades ago. The key is we run an asset management company, and we have to think long term. So we actually do a 10-year business plan for our board to try and get them away from that government budget cycle and think long term, because you're right. Asset management is people intensive. That is the key resource you need to try and create performance, even capturing beta. So we have to think long term as CIOs and think of it as a business.
Right. And the 50 people that we've put on the table is a long-term plan. Historically, under previous CIOs, they would go to budget, well, we need 2 people, we need 3 people, we need 1 person. And we've said, this is what we need. Let's negotiate. Let us show you, most importantly, that because of what we will be able to internally manage, the low-hanging fruit, and this is not a surprise to anyone in this audience, it pays for itself. It more than pays for itself.
Absolutely.
Right.
And you attract better skill.
Right. So, Scott, what do you think about the 7% objective for returns on?
Well, we have a much lower expected return than they do at New York State. We just have to worry about the city, and we're at 7%. which is, I'm kidding, it is a very high hurdle to meet. It's a nominal objective. The actuary takes a look at what's doable over the next 30 years. We actually, believe it or not, for a public pension fund in the United States, have a conservative assumption. If you look at private funds, their assumptions are much lower, in the 4 or 5%. In Europe, 2-3%, and they're very highly funded. So we've got our work cut out for us. But in terms of long-term focus, the system is set up in New York City, and I'm sure it's the same in the others. It's actually set up to be conducive to long-term investing if we'll let it. The actuary measures the long-term liabilities of the plan, and they have a very, very long horizon, 30 years, 3 decades, 4 decades, similar to what Hiro was talking about. Then they look at the assets, and they smooth the value of the assets. Now, when we report funding ratios, we report a snapshot today with the new accounting rules. We report a snapshot of the assets versus the smoothed liabilities. But the actuary actually smooths the assets. In New York City, it's a 2-year lagged, 6-year smoothing mechanism. So that the movements up and down, these quarterly returns, even the annual returns, get smoothed out over time. We have a lot of time before the variances from the 7% assumed return work their way into the annually required contribution that the taxpayers of the city of New York are required to put up. And that's the time frame that we as stewards of this capital should be focused on. It's the time frame that affects the annual required contribution over time. Now, with that as a backdrop, in New York City, we report monthly. And when I got there...
Wait, every 30 days?
You got it.
And in February, only 28 days?
Every 30 days. You know, we would report daily, except we have a little trouble in the back office. And our board was being fed a diet of monthly reports. And the boards met monthly, and they studied these monthly reports. And so it's why is a group that has an 8-year smoothing period, that has a long horizon, focused on these short-term results? It's a problem because as asset owners, we pass on our time horizon to the managers that we hire, and we hire just outside managers in New York City. We put pressures on them based on that time frame, and then they turn around and put pressures on corporations. And then we wonder why we have a system where people are unwilling to invest for the long term. So we really need to own it at our level. We've taken a baby step. I still report monthly. If you want to see what the fire or police pension fund did last month, you can go to our website and see. I don't talk about it with the trustees. We meet less often. We meet 6 times a year. We got 5 boards, so we actually met 54 times a year up until recently. A lot of fun. We got good at board meetings. But meeting less gives our people more time to study the managers that they own. More time to study the managers allows us to get to know them better, to get confidence and conviction in their strategies. That allows us to be better stewards of capital and better investors in the funds that we manage. And having us be more patient gives them the leeway to be more patient with the companies that they invest in. So it's a baby step, but we're kind of just to the place we are with in the other funds, but it's progress in the right direction.
Well, let me, Scott, ask, I'm going to throw a question out to you and Chris and Vicki. Do you think that the new GASB rules, which require mark-to-market, is going to affect pressure on short-term performance?
Yeah, it will, and if we let it. So New York City was an early adopter of the GASB 66, 67, and 68 rules. And basically what happens is that rather than smoothing both assets and liabilities, you take a snapshot of the value of the assets, liabilities are still smooth. So what happens is that the funding ratio is more volatile. And the press focus is on an annual basis, on the fiscal year results. That's when they're used to looking at things, writing columns, looking at funding ratios. And so those funding ratios will be more volatile. Nothing has changed, though. Just the way we talk about it has changed. And so what we need to do as long-term stewards of this capital is to be able to resist the volatility, the temptation to let the volatility of the reported numbers change our behavior. It's going to be tough to do, but that's our job.
Yeah, I agree with Scott that if it's not handled correctly, it could. For us, we know that the first time we reported, because we were not an early adopter, we will likely be reporting both numbers. The way we did it before and the way it really still makes sense to us, the way we really think about our funding ratio and this sort of quasi-market value number. And we'll also have lots of communication and discussion. We'll probably have to go on TV and talk about the fact that we were 99% funded last year and we're 70% funded this year is not because we totally screwed up the investment strategy. It's because of the way the GASB 67 makes us report. So that's going to be, we know it's going to take a lot more communication.
I'm a fan of transparency. I think it's helpful for us as citizens and as members of the plans. But it also, you have to realize you have to explain what that information means. When you're looking at the liabilities, you're trying to forecast a future flow of money. And the future is hard to predict. So you can have multiple methods and you come up with multiple numbers. I think that's actually information. It confuses some people. But you don't just have a single number out there in the future. And I appreciate and we support GASB's moves, but particularly on marking to market, not just the liabilities, but the assets. Let me make it personal for all of you. You can go on your smartphone and you can go on Zillow and look up your home address. Imagine if you do that every morning to see what your house is worth. You would soon realize that's a meaningless number. I may want to know once a year, maybe every other year, but I'm not going to flip my house and sell it all the time and try and buy it again. So it's a data point, but you have to take that number in context and realize, okay, if I'm going to do anything, think about all the stuff in life. Everything takes a long time. The best stuff in life takes a long time to do. If you want to lose weight, so I'll make it another personal thing for everybody. If you want to lose weight, if you weigh yourself every hour of the day, that first day you're on a diet, you're going to stop. You're not going to stick to your long-term goal. So again,
maybe you would eat if you were weighing yourself.
Yeah, maybe starve yourself the first day. That'll work really well. But we're trying to invest in private equity, real estate, infrastructure, things that are long-term investments that are good for America, good for the world, to make long-term investments, but we're getting pressure to measure them almost 28-day intervals, but every day. And what happens is you take your eye off the ball for the long term. And so we've got to find a way to balance that with language, with information. Okay, we'll be transparent, we'll share this, but don't obsess about it. Let's keep our eye on the long term. Let us invest in these long-term areas because the rest of the world isn't. The rest of certainly of the USA is in 401k money. And most of you in the room that have those realize you're only invested in the public markets. You can't invest in long-term things. And so for America, there's actually, I think, a scarcity of long-term money, and it's the pressure on us to get shorter term with our focus. We've got to fight that.
Absolutely.
Well, I think we should pause here for a moment and I'll check Zillow for the price of our homes. Hiro, I don't know that you have Zillow in Japan. Are you familiar with Zillow?
I mean, there's like a quarterly report and reporting frequency, mark to market.
You can actually get online and check the price of your house day to day. So,
yeah, I mean, as Abe administration takes the corporate governance very seriously, so in Japan at the moment, a lot of discussions happening about how institutional investors should work with the businesses and etc. And I actually read the minutes of one of the discussion table, which was between the business and asset managers. And I found a lot of asset managers complaining. Actually, they attribute the criticism of short-termism to asset owners, saying because asset owners short-sighted, we have to work to make the short-term return. So I think when I read that minute, I thought that doing all those like a very frequent return and etc., getting attention from the media all the time is not really helping to just optimize the value chain. So that's why I started the talking, sort of advocating kind of against the quarterly report. But I know as soon as somebody listens to this video recording, my popularity vote goes down again. Because people think, the Mizuno is doing a risky investment and still trying to hide them. So the balance is very difficult. But sometimes somebody have to put the foot down and say, no, we are not going to do this to change the system. And I have a very high respect to Chris being vocal about that. And it's very difficult to be just one doing it. So I understand everybody have a lot of different political and social pressure, and we are operating in totally different circumstances. But to tackle the short-termism issue and how the asset owner or like a big pension report their result is actually have some key to it. Yep.
I think Hiro's absolutely right that we are putting a lot of pressure on managers, and in our case on asset managers, who are in turn putting pressure on companies for short-term pressures and for short-term results. One of the most difficult things I've done, I've been in this gig for about 2 years, dealing with our five boards. One of the most difficult things I've done since I got there is to convince one of our boards to invest in a manager in whom we had tremendous conviction, in whom the consultant had tremendous conviction, and whose short-term and intermediate-term performance was terrible. Terrible. 3-year track record was awful. Retail investors, leaving in droves. Perfect opportunity to invest in this manager that had a well-proven strategy to invest through cycles, with an investment style that was out of favor and had been out of favor, value-based investment style that had been out of favor for the past couple of years. As long-term stewards of capital, with the knowledge and conviction in this manager, the best way we can do our job is to allocate money to this investor at that time, when everyone else is leaving. But the pressures that the boards are under, the lens that they use to view the world, the diet that we feed them of short-term results, caused them to be frozen. They required a lot of discussion as to how could we buy someone who had underperformed for 3 years, which seemed like an incredibly long time to them. And it was just a snapshot to me of the nature of the problem that we have, and the fact that we have not trained our boards who oversee the asset owners to have the right focal length when they oversee the companies. Now, we were successful in getting this investment. Let's hope year 4 is a good one. But it really did sort of capture the problem to me.
Scott, I can relate to this. When we go out and talk to clients, and everybody I meet tells me they're a long-term investor, and then I find at the end of the next quarter that a long term is a quarter.
Right.
So,
yeah,
right? This short-termism.
It's a relative statement.
This short-termism
Right.
it puts pressure on you. It puts pressure on people like us. But I wonder if there is something that we can do with the short term that could actually be good. And that won't, the thing that I think about is quarterly performance of corporations, the pressure we saw after 51 or 52 quarters of growth, Apple had a down quarter and the stock got slammed. So the short-termism flows right up to the people we're investing in. And Chris, I know that you've taken some activist positions, your organization with stocks. I mean, what do you think about this pressure that we're putting on corporations and the very things we're investing in to keep up short-term performance at the expense of long-term?
We definitely feel that tension. I've had some very heated conversations, in fact, with Larry Fink, who was very critical of our investment with activist managers. But Ann Sheehan on my staff was part of a panel here to explain that the managers that we have backed, their average holding period is 3 to 5 years. And that's actually short-term to me, but to a CEO, they realize, okay, that's actually very long-term. There's a whole crowd of activists that are short-term flippers, that like to hedge, that like to play games. We don't invest with those people. They make headlines, they give lots of news fodder, but for us, that's not the focus. Our average holding period for a stock, and when an activist manager of ours gets involved in a company, we already own that company. We probably have owned that company for over 20 years. We're going to own that company for another 20 years. So we're not short-term in our thinking. We do think that activism works because it wakes companies up. It gets boards and CEOs to think more assertively, not short-term. We want them to think with a 3 to 5 year business plan at least. But it gets them to be less complacent. So it's a tension area. But you have to realize that our holding period is very, very long-term. And we think it plays a role, certainly in corporate America, because there are just bad corporations. But I don't want CEOs coming up with 90-day plans. We do want them to work with their board to develop a long-term plan to improve their company. So from our standpoint, activism is just that we are active share owners. We own 0.3% of almost every company in America. We've owned it before, we're going to own it again because we have a big passive portfolio. So for me, I want those CEOs thinking and being active in their management of their company for the long term. I don't mind that Apple had a bad quarter. They're not going to grow incessantly forever. We all realize that we want Apple to be thinking about the next product, not just about whether to make the next iPhone bigger and smaller or maybe a square. But think about whatever that next product is, because it's the biggest company in America. It's the biggest part of probably most of our portfolio, certainly Hero, your US portfolio. Apple's going to be the largest stock. So how that company performs long-term matters. What happened in the last 90 days, how many iPhones they sold or Apple Watches they sold, don't really care. I care more about the long term and their R&D and what they're doing.
So I would agree with Chris. Like CalSTRS, we run a very large indexed portfolio, and with the activist managers that we have in place, but we've actually seen it pay dividends to our long-term holdings because they come into a sleepy company and have a turnaround plan, and maybe a plan to sell assets that are not generating the sort of returns that the company needs. We couple that, as does CalSTRS, with an active engagement program. We have a very deliberate corporate governance program by which we vote our proxies, write letters, propose resolutions, and sometimes I know that companies view us as a pest because we will come back again and again and again, whether it's on reporting of climate change or board diversity or other considerations, because we know we're a perpetual holder. So while we'll get the blowback as well, our position is there is not that is perfect alignment to invest with the activist managers that we invest with our long-term goals.
Hiro, do you seek to impact corporate governance in Japan?
Yes. As at the moment, we have no in-house equity investment capability, so we 100% outsource to the asset managers for Japanese and non-Japanese equity. And when it comes to Japan, corporate governance has been a big agenda, as I just mentioned earlier. And then, so we have been not directly engaged with the companies because we are not direct owner of them, but we are taking a quite big initiative in how to improve the relationship between asset manager and the businesses. So we recently made a very clear statement in our report of the Japanese, asset managers' stewardship activities with respect to Japanese corporation. And I made two strong comments. One is that you have to be a role model of corporate governance, because I'm not very satisfied with the corporate governance quality of asset managers. So I said that before you go to walk into CEO's room and discuss their corporate governance, you have to have your own corporate governance perfect. And the second is we also did a survey with the Japanese listed companies, and noticed that they have making a lot of criticism about the investor short-termism, and they even criticize sort of short-term trading. So we made a clear statement like, it's actually you basically take the advantage of the trend against short-termism, because short-termism doesn't necessarily mean the period of holding is short. It should mean that the people, when they analyze the company or evaluate the company, they should take the long-term business plan into account. So we made a clear statement that we need active manager, we need activist type of investors to make market more efficient, because we are heavily passive. And by definition, if there's no active manager or no activist type of investors, index becomes very inefficient, right? By definition, if everybody is passive, passive becomes very inefficient strategy. So we need active management. We have to encourage them to be actively trading. And also, as we are such a long holder of equities, so the best way to pressure the business with a sort of sense of time or timing or the sense of urge, I think active investors have to trade quickly, because passive, we can wait 10 years. But we cannot let the ECO sleep on the assumption that we are passive investors, so they can, we can wait for 10 years. We need to give them an urge. So that's one reason we keep encouraging active manager to work for us and try to just keep a pressure on the businesses. So
Scott, can I jump in?
Sure.
Hiro, if you'll commit to taking on Japanese companies, I'll commit CalSTRS to team up with you and help. Because we've been part of the Asian Corporate Governance Network for over a decade, and we've been trying to get corporate Japan to care about corporate governance. And I'll go so far as, it's not my fund, but I'll pledge CalPERS and Ted Eliopoulos that I know he would join in, that if you want to take on the companies, we'll team up with you.
Oh, definitely.
We'll help.
Well, this is going to be big. Well, I think a lot of people are scared of what I'm going to do with the corporate governance thing, so I shouldn't scare our stakeholder too much. But
let us take the heat. We'll take the lead. We just need.
But Chris, I take your offer. But one thing I would like to do is, we are actually a big shareholder of U.S. corporation as well.
Yep.
So I'm actually thinking of the coming up with a very strict shareholder, proxy voting guideline for U.S. companies to begin with.
At your size, I welcome you.
Yeah, so we can team up to title U.S. corporate governance first.
Sounds like a making of a partnership.
Let's team up right there. You're on.
Yeah, but I think it's a good idea for the asset owners to exchange note and work together. And also, we cannot let the asset managers keep complaining about our short-termism or a lack of attention to the corporate governance. So, well, sorry to say that, but I think we have to team up to just make it much more aligned.
Well, I think we're going to be making major headlines in Tokyo in the morning. And you were here at the Milk and Global Conference making history today. So, this will be a big story in Japan, I am sure. So.
Yeah, but let me clear that at the moment I cannot be directly engaged. But I think I hope that all the asset managers who manage Japanese equity for us should understand our intention that the asset owners are serious about Japanese corporate governance. I think that's the key message, and we will see how we work together.
So I have to ask Hiro one question. I'm sorry, Scott.
No, it's fine.
Just since it's on my sheet, Does your size raise concerns about your influence on the markets of Japan?
Yeah.
Yeah. Okay.
Yeah. We own. Yeah. I mean.
Right. So we're really making news in Tokyo right now. Scott, I'm sorry. I cut you off.
Oh, I didn't.
Oh, I thought you were going to throw in some
No, I
chestnut
can.
for us.
I mean, I think here is absolutely right. There's already a well-established group of international asset owners, asset managers called the International Corporate Governance Network that is working. I'm not sure if you guys are members. I think the California plans are working together to improve corporate governance throughout the world in all capital markets, and so I think it's a 2 steps forward, 1 step back process, and has been for the last 20 years. But I think it's very exciting to have the largest asset owner in the world interested in corporate governance and believing that it's a fundamental part of the asset owner's job in any market. Hiro touched on a tension that I think we need to think about in terms of managing companies for the long term and so forth, and that's passive management. And as Hiro said, if you're a passive manager, you're a permanent owner, but you've kind of checked out in terms of engagement on the specific strategy of the company. And what we've all done in the corporate governance world is from a corporate governance perspective, we say, look, we're permanent owners of these companies. And so therefore, we want to see all the companies in our portfolio take a certain set of principles, independent audit committee, so forth. We've been big on proxy access, which is give shareholders the vote. We, the shareholders, own the company. We ought to be able to have some sort of say in terms of who the board is that governs it. And so we've been very successful with the help of others on stage and those that aren't, or in the International Corporate Governance Network and others, to move this ball forward so that there is a voice for shareholders in how the companies are governed. But if you look at big pension funds around the world, increasingly in the public markets, we're passive. We're index players. Over 70% of our assets in the U.S. equity market are passive. And that's the appropriate thing from a perspective of how can a big clunky a group that manages as much money as we do hope to add value over time. It's right to be passive. But the active people that have to drive the train, that have to make things work over time, they have to be long-term stewards. They can't all be speculators. They can't all be hedge funds. The people who govern the companies, who are actively involved in the companies, have to be long-term stewards of the capital. And so what we're missing is the group of asset managers that are long-term investors in various companies, are involved in the governance, have long relationships with the people that are managing them, and have a deep understanding of their strategy. That's missing. And it's leading to a lot of problems in the short-termism. I'm not sure what the answer is, because we hold all the competitors. And so we couldn't have a board seat on all the competitors, too much information share. I'm not sure what the answer is, but as long-term active management recedes and is replaced by alternative investing on the one hand and indexing on the other, there's a governance chasm that opens that needs to be filled.
Can I say one thing?
Yes, Hiro.
Can I say one thing about passive managers? It is true that in the past, we selected a passive manager by basically a cost, because tracking error is negligible. So it's basically we pick the very low fee passive managers. But recently, I keep sending a message to the passive managers. We expect you to engage with businesses to improve the corporate governance. So their initial response is, we paid very little. And we have, as far as Japan is concerned, they have about 2,000 companies listed. So we are not paid enough to get engaged with the 2,000 companies. So my response has been, we are going to evaluate our passive manager by how you pick the company you're going to be engaged and how you're going to approach them. And I said, I'm very happy to pay higher fee if your proposition is plausible. So I actually thought that because our passive, we hold a lot of the lion's share of our equity investment through passive. So they have more voting power. So I've been very clear that the passive manager, we expect you guys to do more than what you have been historically doing. So I call it, I say, I would like you guys to aggressively passively manage. So we call you guys aggressively passive manager, not passively aggressive, okay?
Well, let me.
That's what the Japanese are criticized about. We are passively aggressive. But.
I think it's a very interesting idea. And you're turning on its head a bit the role of passive management as it currently stands. They're not set up to do what you're asking them to do. They'll have to retool and rethink what they do. But when you think about it, we've paid active managers for many years to be experts in the market and understand the companies and the strategies and so forth, and buy and sell shares. To actually pay people to be long-term permanent owners and be engaged with the companies as owners. Yeah. That doesn't exist today. It's a very interesting idea. You guys are certainly big enough to get their attention, Hiro. I think I think it's a very thoughtful idea.
Oh, thank you. I'm really hopeful that our passive manager, or including a potential one who want to get a mandate from us, come up with the interesting proposition or proposal, how they think they can be more effectively engaged with the company. And if I'm convinced by their proposal, I'm very happy to just change our fee structure for them.
I'd just like to add one comment. I agree with both of you. For all of us, passive is a choice, right? It's not a requirement. And one of the challenges, one of the things we do internally is challenge ourselves to say, yes, and maybe in the mega cap, it makes perfect sense, but maybe it's that we don't know the managers that could be sort of like what Scott said. And if we had a contract with them that wasn't that we were going to measure your performance on a yearly, every 3 year, every 5 year, but we were convinced that the process and the philosophy made sense, that we wouldn't need to be passive. Because I get concerned about it being, well, we're just passive. But we're not, right? Because we're hiring activist managers, we're engaging. But I think there's probably something in the middle that we are missing. And maybe the point is for us to call out that to managers, we would be interested in that strategy as a way of really aligning ourselves with the returns that we want to generate from economic prosperity or global economic growth.
Yeah, it's more of a permanent ownership strategy rather than a passive strategy. I mean, passive as opposed to active, we're not trying to add alpha.
Right.
You're saying we're going to be permanent owners. Let's hire somebody who's going to be able to be your agent, to be a prudent steward of capital. There's an entrepreneurial idea with $1 trillion behind it to my right for managers out there. I think it's an awesome idea.
Well, we'll start work on it right away. It is an interesting idea, though. But it's interesting. We're talking about compensation here, and one of the issues is passive strategies are entered into because they're so low cost. And of course, active management has not proven in some asset classes to produce alpha consistently, and that's a challenge. But turning more toward compensating your managers and then also compensating the people internally, do you think, Vicki, that the compensation system that exists, let's say just in your organization, is the appropriate compensation to be necessary to attract talent and reward them for success?
No, I don't think so at all. This last year, we engaged in a sort of full transformation project for the plan. And even when you said, and we looked at compensation across all of the public funds, as well as the endowments and foundations, people who are coaches in the state of New York, what they make, which is interesting because they make a lot more than people who are the fiduciaries. And I actually believe, particularly in the U.S., I mean, there are some public funds who've addressed it, but generally there is a huge disconnect. For example, not surprisingly, we have a sole trustee, we have an investment committee. We could decide to hire a partner in a strategy that we really needed, billion-dollar mandate, negotiate the fees. But the principal investment officer, who would be guiding that transaction and relationship through investment committee, if I want to pay them $300,000 a year, there's a huge hue and cry. And in order for all of us, for the welfare of the millions of people we serve, for us to be able to provide that secure pension in a DB form into perpetuity, we're going to have to fix that, or else folks like my organization will lose in the race for talent, and it will become a self-fulfilling prophecy that we can't meet the target rate of return. And so that is the reason I have become very vocal. But it's an issue that I believe other jurisdictions, like the Canadians, have solved. And if you look at a CPPIB, for example, who pays compensation that I can only hope in another lifetime to be able to pay to my staff, their overall cost is about the same as ours, and we're getting that cost reduction just from passive, because we don't have the staff, we're paying premium for the alternative. So it really is something we've got to fix.
Yeah, when you consider that, somebody in your shop that might be responsible for $1 billion worth of private equity,
right,
where you're paying the private equity manager maybe $30 to $50 million a year,
right,
that you're going to pay that person
150.
Yeah.
Yeah.
Exactly.
So it doesn't make sense.
Right.
But I actually I actually believe calling out, being transparent, discussing, letting our pensioners know what the implication of this is, because the irony of our system is that it all comes out of our fund, whether it's the management fee or the salaries. Right. So there is no disconnect. It's not as if our salaries are determined by an appropriation. But as I said, if it doesn't get fixed, it's the you won't meet the target rates of return. You won't have the talent. So,
I mean, it's even a difficult thing on my side of the business when you speak with clients and you'll say, well, we beat the benchmark by 200 or 300 basis points a year. And they'll look at you, but they'll say, yeah, but your fee's too high. And I always say, why don't you look at the return net of the fee and compare that to someone else? And yeah, sure, we should be able to negotiate on the fee, but there has to be a point where you can actually pay to get the work done. And I think that when I look at public pension funds in general, that a lot of the experience and expertise you need, you can't afford to pay. So, I mean, Chris, do you?
Yeah, no, I totally agree. In our shop, in the public markets, it costs us about 1/10 the cost to run money in-house as it does to hire an external manager. And if you look at the private markets, if we could run money in private markets and do direct deals, it would probably be 25 times cheaper to run that money in-house. So the Canadian model is a classic example of where, yes, their cost structure is net even with yours, but they've shown already after about a decade that they have been able to add value Absolutely. Above that by being both an investor in partnerships, but also a direct investor. So fees matter, costs matter. I mean, it's a drag on our performance. We all pay attention to it, but you can't over-obsess on costs. If there's anybody in this room that's thinking about getting LASIK, you could go get LASIK here in Beverly Hills, or maybe over in, I'll pick some other part of LA, or you could get it really cheap by going down into Tijuana. Think about your outcomes. So costs matter, but if you over-obsess about it, you're not going to get that net return. And Scott, you hit it on the head. I constantly say to our board, fees matter, but it's about the net return. If we don't make, in our case, 7.5, saving money on fees does not matter. We have just simply failed. So we know in life, you pay what you get for. And I think that has to be applied to internal management and to running the pension plans. all of us face that issue. In the USA, the public pensions are still operated under the governmental business model.
Yes.
Something out of the 1970s. Look at all the university endowments. They're all off campus and they're almost all investment management companies. Look at most of the corporations. Their pension plans, what's left that exists, oftentimes is run as a separate business entity. But all the Canadians, a lot of the Europeans, certainly the Australians, and almost all the sovereign wealth funds aren't run as a governmental entity. They're run as an external investment management company. In the US, because we were first, we're just stuck with this legacy system. Eventually it will change. I don't know what will cause it, but I'm hopeful someday it will change. It has to. It's a flawed business model.
It's a flawed business model.
Do you agree?
Yeah. Now I'm going to become unpopular, at least with the managers.
But Scott, you came from TIAA-CREF.
Yeah.
I mean, there's a classic example of
Chris,
the
let's
biggest
not bring
fund.
up the past. I'm sorry, classic example.
No, but a classic example of where a huge pension plan and
Yeah.
moves into a quasi for-profit business model and operates like a money manager.
Right, right. And it made sense for TIAA-CREF and the structure that we had. There were similarities to what the Canadians have. There are a lot of pieces that would have to move for U.S. public pension plans to pay the type of compensation that the Canadians do. Look, the Canadians, they're paying too much for private asset services, so they decide to hire their own resources to disintermediate the managers. It's a sensible long-term strategy. But the hole that's opened up is that the managers themselves are charging too much for the value that they're creating. These private asset classes need to have hard hurdles that are based on the opportunity cost. How much value are you adding relative to what we would get if we just invested passively? And then based only on the excess return that is delivered over that hard hurdle, there should be some gain sharing between the general partner, the agent who's actually creating the value, and the limited partner, the principal who's providing the capital. Right now, when you tease out, and it's tough in some asset classes because there's not that much transparency, and that's changing. And we've had a lot of help from a lot of the people in this room to change the transparency. But when you tease it out, the balance of value added, true value added, is going way too much in the favor of the general partner and way too little in the favor of the limited partners, the asset owners, the LPs. And that's driving this movement of those who are structured to be able to invest for themselves, you know, TIAA-CREF and CCPIB and Ontario Teachers and others. We're not going to do that. In the public pension funds, if we don't like the deal, we can't change the structure. We'll just get out of the asset class. We'll just walk out the door. And you know, I've got 5 boards. One of them just took a hike on hedge funds at the last meeting. And they're not too happy about private equity. And they're not too happy about private real estate because the balance is not right. I firmly believe that these private asset classes add value to the mix. And partners like the one sitting to my left have really created value for the 715,000 beneficiaries in the city of New York. But we have to have a square deal, a more transparent deal, if this is going to work long term. Otherwise, you know, the public pension plans will be discussing much more the governance issues of indexing because we'll be back to the public markets. I can run a pension fund in New York City, $160 billion in public indexed assets for less than 2 basis points. I can't do what Hero's doing, which is very interesting to me in terms of the governance. But I pay a lot more than that today. But I need to be able to convince my board that we're getting good value and that there's good gain sharing for the true value added.
Well, when it comes to asset manager fee, we obviously pay like a couple of $100 million as a management fee, even before we start alternative investment. And now we got approval to make alternative investment up to 5% of our fund. So if you apply 220, the traditional private equity fee structure, how much we will end up paying as a fee to the managers is going to be shocking. But at the moment, my focus is more on the absolute amount of money we pay as a fee. I'm more concerned about the alignment of interest between asset owner and asset managers. Because I spent the last almost 2 decades in a private investment where LP and GP, although I agree with Scott, I mean, the sort of absolute level of the fee we pay to private equity is a bit too expensive for the job they do, particularly the fund size is now growing. But at least in the private investment area, the alignment of interest between LP and GP are always very heavily discussed. Mm-hmm. But when it comes to the public market, I really don't see that level of the discussion on how we align our interest with money managers. So that's my biggest concern, and that's my top agenda, how to improve the alignment of interest between public money manager and ourselves. So they don't have a skin in the game, most of them, right? Because I don't see many of the other big money managers making their personal investment in a fund. And also now they are accepting, or starting with the non-Japanese fixed income money manager selection, we basically urged all our money managers to offer performance-based fee scheme. So that's one step, but I really don't see their skin in the game. And the second is, in the private equity investment, they usually have the clawback clause. So when they cannot satisfy our performance expectation for some period of time, they have to return the success fee. I don't see that very commonly used in public managers. So that's actually my biggest concern at the moment. Of course, the actual amount of money we pay is a concern of our board and our pensioners, but I think as an asset owner, we have to really pay attention to how to strengthen alignment of interest between us and asset manager. That's my top agenda at the moment.
I think that brings up an interesting point, and that is when you're looking at these alternative asset classes, how do you get aligned in interest? Because, I don't want to name any firms in particular, but when you're raising, a $2 or $3 or $5 billion fund, perhaps the alignment of interest isn't as strong as if you're doing, a $500 million fund. I mean, Chris, how do you?
No, it's really tough. I mean, as Scott said, there's been a lot of criticism in the media, and particularly on the internet, about the partnership structure. But that was created to try and create a better alignment. Right. It was the idea that, we'll pay you a fee to operate your business, but then we'll allow you to share some kind of an incentive for the outperformance. And the problem is the clawback isn't as strong because you want to be able to get, it's a two-way street. I'll pay you an incentive for outperformance, but I want you to pay me back for underperformance. And the partnership structure doesn't allow that. There's a question of transparency. So I think alignment's absolutely critical. Both, Hiro, I totally agree. It's important in the public markets and it's important in the private markets. And Scott, you're right. I think there's an absolute focus that the fee split has been too generous to the general partner.
I agree.
Obviously, we've documented evidence from the SEC of some general partners who didn't exactly follow the partnership structure or went around it. And those are the things that we as the investors have got to shut down and hold people accountable. We're constantly searching for a better alignment. I said yesterday very clearly the 2 and 20 model is broken. For funds of our size, it has been negotiated lower. Sure, Wall Street loves to start with that as a business model, and people that start with a fund begin there. But they've got to realize that template has been busted, and it is a matter of trying to align yourself with your investors to trying to find a better way. We'll pay a fee to help you operate your business, but if you've been around for 20 years and you've got all these legacy funds, we don't need to be paying a management fee for you to operate your business. We'll pay you an incentive, but by gosh, we want a clawback, and it's on the total partnership. It's not on each individual investment you do. So alignment of interest and transparency are huge issues in the public markets. The four of us are pushing on them. We're amongst the leaders with ILPA and private equity and PRIA and real estate, and infrastructure is going to need that too as another private asset area. And we're constantly trying to find that better alignment, that better model, so that there is some sharing, because we want to pay for the talent.
Yeah, I think the thing to be clear about is better alignment doesn't mean lower pay to partners who are truly adding value. And in private meetings with the partners that we have that have contributed extraordinary value to the people in New York City, I point out to them that they're actually the pay structure, the things like the catch-up in private equity, they reward mediocrity. They reward the players who aren't adding value over time. And so in a new world where you had where you have a perfectly aligned structure that's paying a share of true value added, the superior firms are going to make more money, not less. You'll command a premium, and if you're adding value for our participants, we'll be happy to pay it.
Yeah, I think that the message or the theme that I'm hearing here is that what you really want is someone to be a partner with you.
Absolutely.
And partnership, I always say, is not about sitting across the table. It's about sitting on the same side of the table and sharing in the rewards and dealing with the failures. And I think that that's a model that's going to be absolutely essential in the future, and certainly necessary for firms like mine to succeed. But I do want to say it's a real honor and privilege to be with you folks today. Hiro, having come all the way from Tokyo, I hope the news goes well when you return home. Scott, as a client, thank you very much. Appreciate it. Vicki, it's always a pleasure.
Thank you.
I always enjoy seeing you.
Absolutely.
And Chris, you and I go back further than all of us. So thanks for bearing with me for all these years.
You do a great job, Scott. We'll do business someday, I have no doubt.
And thank you all for attending. Please put pressure on Chris to give us some business.
Thank you.
Good to be with you.